Now let's see what are the various methods of valuing real estate properties. The first one, and again widely used, is a comparable sales method. Here we try to estimate the property value on the basis of a recent sale of similar property or a transaction of a similar property that has happened, which is comparable to the property that we are valuing. Now that comparison could be based on varied features. Now obviously this value is adjusted for the differences in the property that you are valuing and the property that you are comparing. So say for example, I am trying to value a bungalow on the suburbs of a urban city. Now the way of valuing that bungalow under comparable sales method is that I will try and see that what is the price that has been fetched by similar bungalows sold in the vicinity of that area itself, and how far back they were sold, whether it's a 1 month old transaction, 2 month old transaction, 6 month old, or 1 year, and accordingly adjust. Now obviously these adjustments are for the factors that are listed here, where the first one is for locality. Obviously there are the real estate prices are different for different localities. If the property is near the urban city, it is highly valued, or if it is in a rural area, it is at a lower price. So locality does matter. Even within a city, different localities can be valued at different prices. The second factor that is adjusted for is the condition of the property. If the property that you are selling, or the bungalow that you are selling, is in a newly furnished form, if the building is recently constructed, etc., then it will obviously fetch a better price than the property which you are comparing to is an older property. The age of the property. So condition and age both go hand in hand. Obviously the younger the property, the better the condition in most cases. Size of the property. If the plot that you are comparing to, or the property that you are comparing to, was smaller in size, then accordingly you will adjust that value for your property to at a slightly higher level, because your property is a slightly larger area. So you will do the adjustments for size also. And lastly, the price changes that have been taken place in that area between the date on which you are valuing the property and the date of the comparable sale transaction that you are taking into consideration. The second one is the income methods, where the first one under that is net operating income approach. So let's understand this. In this case, we start with the potential earning of the property that is being valued. So here we estimate the property's gross expected annual income. What are we expecting to earn out of this property? If it's a commercial property, then the entire square feet area multiplied by certain rental charges that you are charging to tenants. If it's a residential property, then it's a tenancy rates for residential property and all that. So we try and get the gross expected annual income of the property. From that we adjust for any collection losses or vacancy rates that are affecting this property. So if there's a commercial property, there's a big retail mall where there are showrooms, and we see that 5% of the space is unoccupied, so that is the vacancy rate. So if the entire property's expected annual income is say $1 million, there's a vacancy of 5%, so we adjust that and we get a $9.95 million as the gross expected annual income post consideration of vacancy. There could be collection losses also, where you are not able to recover certain income from the tenants or other kind of revenue sources. So we adjust for that also. Now please note that we will not reduce depreciation, finance costs and income taxes while calculating this net operating income. We'll only reduce the operating expenses with respect to maintenance, repairs, utility, insurance, etc., not depreciation, finance cost and income taxes. And then we get the expected annual net operating income of the property. The next step here is to find out a capitalization rate. This is the rate at which you are expecting the property to generate a return for yourself, and this rate is typically the discount rate that you're looking at minus the growth rate that you are expecting from the property. So the capitalization rate, or a cap rate as it is popularly known, is equal to the discounting rate that you are choosing for the property minus the growth rate that you are expecting from the property over future years. The last step here would be to divide the annual net operating income by the cap rate to get the estimated value of the property. So let's take an example. The value of an apartment building is what we are trying to do here. We are expecting the apartment building to earn $250,000 if fully occupied, but there is an 8% vacancy rate and 2% collection losses in the property. The operating expenses of the property are $45,000, which includes maintenance charges, insurance, taxes, utilities, etc. And our required rate of return on the property is 12% on this investment. So let's value this property. The first step here is, obviously we have the gross annual operating income of $250,000, which we will adjust for the vacancy rate and the collection losses, that is 8% and 2% respectively. And thereafter we'll reduce the operating expenses, that is $45,000, to get the net operating income of $180,000. And we will divide this net operating income by a required return of 12% or the capitalization rate of 12% to get the property value of $1.5 million. Now say for example you could be given in the question that the value of the property is there and the net operating income is given to you, and if both these things are given to you, you can solve for the required return of the property. So say if the property price given to us is $2 million and the net operating income that is generating per year is $175,000, then the required return on this property is $175,000 divided by $2 million, that is 8.75%. Pretty straightforward. The another method of income approach is discounted cash flow method. Obviously it's very straightforward. We have seen this multiple times in the CFA curriculum. The idea here is to project or estimate the property's annual operating cash flows over the fixed period or finite period in the future, and we estimate the terminal value, or in this case called the resale or reversion value, at the end of the fixed period which we intend to hold the property for. And this is often estimated using a direct capitalization approach, meaning say we are intending to hold this property for 5 years or 7 years. So we'll use a direct capitalization approach to value the property at the end of 5th or 7th year, and that will be our resale or reversion value, and that is discounted to the present day for the DCF method. And the last one is the replacement cost method. Obviously the name suggests that the value of the property is determined in the form of what is the replacement cost of such a property, and this is estimated by estimating the value of the land on which the property sits. It will also include the cost of rebuilding the entire property, that is using the current construction costs and the standards. So say the property's construction was 10 years old and now the technology has changed, the construction material prices have changed, etc. So the cost of rebuilding the entire same property at current costs and standards will be included here. And obviously the cost of building materials, labor charges, tenant improvements, and architectural and engineering costs, that is architectural fees and engineering consultant fees will be included, plus the legal charges, stamp duty charges, insurance charges, and brokerage fees for brokers, etc. All these costs are also included in the replacement cost method. So these are the three methods of valuing a real estate property.